The question we view here is the park company. It's a risk management questions exist in section B, the scenario-based objective test question. So let's go through with it. So here is the background information, and same in other case, please read it by yourself, and we'll go through it after you are reading it. So just pause your video, the video now, and once you finish the reading, just come back. Park company here is based in a country whose currency is in dollar, and the company is regularly importing goods denominated in euro, so its foreign currency is euro, which is the payment in euro, and regularly sells goods denominated in dinars. So it's exporting products to a country, the currency denominated in dinars, so it has the receipt in dinars. Two of the future transactions of the company are as follows. 3 months' time, it needs to pay euro 650,000 for imported goods. And for 6 months' time, it will receive 12 million dinars for exporting capital goods. And the company has the foreign exchange rates and interest rates available for you to work it on. It has spot exchange rate for dinars to dollar, and it also has the spot exchange rate for euro per dollar as well. And it has the 6-month forward rate for dinars per dollar because it has the receipts in 6 months' time. And also it has the 3 months forward rate for euro per dollar because it has the obligation to pay in euro 3 months' time. And also the information here also include the 6-month interest rates, which are the dinars, have borrowing rate and deposit rate, also has the dollar rate as well. And the finance director of PARCO believes that the upward sloping yield curve reported in the financial media means that the general level of interest rates will increase in the future, and therefore expects the reported 6-month interest rates to increase. So it may be for you to understand well of the background information as well for some discursive questions, okay? So for the first requirement here is about the future dollar value of dinar receipts using money market hedge. So for money market hedge about the receipts, just repeat the steps that we should familiar with, because for money market hedge, understanding well the steps are the first or the most important part in answering the question correctly. Because you have the dinar receipt in, say here in 6 months' time. So you right now, you borrow foreign currency. Here in this case is dinar, the foreign currency. Now, okay. Second step, you convert or exchange the foreign currency into dollar, as local currency. Now, at spot rate. Okay, so for the first step, you place your dollar as local currency into bank deposit. And step 4, you receive the customer. Receipts from customers to pay the dinar loan. Okay, so here you have the fourth step to follow, and you have to find out the future dollar value here under this situation. So how much that you will receive now? You will receive 6 months time. You will have 12 million dinars. Okay, and you have the borrowing rate for dinar at 4% for 6 months time. Okay, and deposit for dollars is only 0.5% in 6 months time. So here the working is you have 12 million dinar here. Divided 1 plus 4%, because in 6 months time you will get you will get 12 million dinar to pay back your loans, including interest. So in this case, you have to consider interest back. So how much that you borrow now is 11,538,462. Okay, so you deposit this 11.5 million into the dinar. You borrow this money from the bank, 11.5 million dinar from bank, and you will pay 12 million back to bank. This is the first step. The second step is you convert it into dollar now and by the spot rate. So here the dinar is 11 million. So what's the current spot rate? The current spot rate for dinars per $1 is the bid price and the ask price. So as I said, you convert a dollar, which should give you a less dollar received now. So should use this offer price. In terms of dollar, it is 200,599, and step 3, deposit this dollar amount to earn interest rate, which is 1 plus 0.5%, and you will get how much is it? 6 months later, you will have the receipt in dollar, $201,602. So here is B. All right, here is B. So remember, for this kind of question, you understand well about the steps for money market hedge. And the next step is how to put the numbers. I show it to you because you have the foreign currency receipts. You can borrow foreign currency now, and how much that you borrow is you expect 12 million received, that a maximum amount to pay, you can repay is 12 million in foreign currency, and then divided by 1 plus the interest rate, which is 4% here. So right now the maximum amount you can borrow is 11.5 million dinar, and with the current spot rate, okay, the amount you can change to US to dollar is $200,599, and deposit this amount with the deposit with the interest rate stated. You can receive the local currency in 6 months. Here should be in 6 months time at this 201,602. All right. Next part is a discursive question. The park company will find which of the following hedges to be effective in hedging the foreign currency risks of the two transactions. So in other words, here is about how to manage the exchange rate risk, because the company the payment in euro and the receipt in dinar. So here let's see, because the payment in euro and receipt in dinar, and it is expected the currency will have some changes in next couple of months due to the Chinese director have different belief of it. Then you can see which one should be correct here. Leading euro payment on these imported goods, is it effective or not? Yes. Okay, definitely you can pay earlier to your supplier because they are more than happy to receive the money back from you right before or much before the due date. The second statement is taking out a forward exchange contract on its future dinar receipts. Yes, it's possible to do it. Third one, buying a tailor-made currency option for its future euro payment. Sure. Currency option is an financial instrument as well. And here, leading the euro payment is the internal hedging method. And for these two, the financial instruments is the external hedging. All right. So because all of these are correct, the correct answer here is D. Next part 3 of this park company question. The requirement is which hedging methods will assist park company in reducing its overall foreign currency risk. Keyword is overall foreign currency risk. First, taking out a long-term euro-denominated loan. Okay, euro is the payment, and dinar is the receipt. Okay, so for euro, if we are applying the money market hedge or the MMH for euro, because we need to pay. If we would like to hedge the risk by money market hedge, we borrow dollar and deposit euro here. And for dinar is euro. It's opposite because we are receiving dinar, so we borrow dinar and deposit dollar. So based on these money market hedge concepts, we understand that the second statement, yes, taking out a dinar denominated overdraft is a way to reduce the overall foreign currency risk, because it matches the assets and liabilities. It matches the assets and liabilities. Here, overdraft is liability. Okay, and the asset is the account receivables or the trade receivables. Okay, in dinar. So here is the matching assets and liabilities, which is a way to hedge. But the third statement, we have the payment already in 6 months' time. So in other words, the first statement is increase the liabilities instead of match the assets and liabilities, right? So it's not correct in reducing the overall foreign currency risk. In this case, option A is correct. Sorry, option B is correct. Option B, 2 only. The fourth one, which of the following statement is or are correct? First statement, purchasing power parity can be used to predict the foreign exchange rate. Yes, it's the S1, but S1 is spot rate, right? And here use the term forward exchange rate. It's F0 or F1. So it's not correct because purchasing power parity is not used to predict forward exchange rate. For forward exchange rate, it should be the job by the interest rate parity. And the second statement, the international Fisher effect can be used to predict the real interest rate. To predict the real interest rate, it should be purchasing power parity theory. It's not the job by international Fisher effect. So here is not correct as well. So neither 1 nor 2 is correct here. The answer is D. For the Part 5 of Park Company, the requirement is which of the following statements is consistent with an upward sloping yield curve. So remember the yield curve here. It's time to maturity, and here is the yield or cost of capital. And when we talk about an upward sloping yield curve, okay, an upward sloping yield curve, it means that the yield will be increased when the time to maturity increases as well. So what's correct or consistent in the following statement with this upward sloping yield curve? First statement here, the risk of borrowers defaulting on their loans increases with the duration of lending. Yes, because when the duration increased, the risk of default should be increased as well. The chance of default is increased. B, liquidity preference theory implies that short-term interest rates contain a premium over long-term interest rates to compensate for loss of liquidity. It is not true. It is not true for B, because liquidity preference theory implies that the long-term rate, the long-term interest rate, contain a premium over the short-term interest rate, or is it's not the case here. So it's not correct. C. Banks are reluctant to lend short term, while government debt repayments have significantly increased the amount of long-term funds available. It's not correct. D. The government has increased short-term interest rates in order to combat rising inflation in the economy. It's also not correct. Why not correct? For C, banks are reluctant to lend short-term. No, it's not true. It's not true. It depends on the risk assessments, the interest yield, and etc. Whether the match is deposit based. And for D, the government has increased short-term interest rate in order to combat rising inflation in the economy. Combat rising inflation in the economy by raising the short-term interest rate is not consistent with an upward sloping yield curve, because here, if you only increase the short-term interest rate, it means the yield curve will shift from this to like this, to a flat rate, or even a downward sloping. So it's not true for the part D. So the correct answer here is A.